We actually think we need a period of growth below potential. We also think that there will be, in all likelihood, some softening in labor market conditions.
That is Jerome Powell giving you all a warning that the 2022 recession is about to get a lot worse. Now is the time for you to prepare, because we are about to see a huge surge in layoffs, a huge surge in bankruptcies, and a big crash in both the housing market and the stock market. Now, before getting into all of that data, we need to address the elephant in the room, and that's the fact that a lot of people say right now that America is not in a recession. In fact, Jerome Powell in that same press conference said that he doesn't think the U.S. is currently in a recession. Meanwhile, Janet Yellen and Joe Biden don't think the U.S. is in a recession. They say that the 2 consecutive quarters of negative GDP growth that we just experienced is not enough to declare a recession official, because the labor market is still very strong. The unemployment rate is near 3.6%. Are they right? Are they wrong? Well, let's ask the American people. According to a recent poll from the Morning Consult, 65% of registered voters said that the U.S. economy is currently in a recession, while only 20% said we're not in a recession. Meanwhile, the optimism of small businesses has now fallen to a near record low, even lower than it was at the peak of the pandemic, and nearly as low as it was in 2008 when the last financial crash got really bad. And the thing about a recession is that it can become a self-fulfilling prophecy. If this many American people think a recession is occurring, if this many small businesses are preparing for a recession, then a recession is obviously going to occur, because ultimately it's American consumers spending their money and small businesses hiring people, which is the lifeblood of the U.S. economy. And in order to understand this recession, so you can make proper preparations and save your money and know when the time to buy into the housing market and stock market will be, is to be forward-looking. Let's understand if this recession is going to get worse and how bad it's going to get. Because right now, all this debate on if 2 consecutive quarters of negative GDP growth is technically a recession, I'm sorry, it's kind of a waste of time, because we're looking backwards. We're looking into what happened in the economy over the last 6 months. We need to be looking forwards, which is why that statement I showed you from Jerome Powell in the beginning of this video was so concerning to me. I'm going to play it again just so you understand what he said.
We actually think we need a period of growth below potential. We also think that there will be, in all likelihood, some softening in labor market conditions.
That's the chair of the Federal Reserve being very blunt about saying that we need slower economic growth going forward, and that it's very likely there's going to be layoffs in the labor market. I was shocked when Jerome Powell said that in his latest FOMC meeting, because normally the chair of the Federal Reserve is not so open about forecasting a recession. And the reason Powell has this pessimistic viewpoint is because he understands all of the severe economic headwinds that America and the world is facing right now. I mean, think about it, everyone. We have a combination currently in 2022 of 40-year high inflation is over 9%, to go along with record low consumer sentiment. The University of Michigan just produced another horrible consumer sentiment reading, to go along with a Federal Reserve that is now hiking interest rates to combat inflation. That is a recipe, a cocktail historically, that has always doomed the economy. For instance, let's just take a look at inflation. We can see over the last 50 to 60 years, each time we have a run-up in inflation in America, whether it be 2008, whether it be 1990, whether it be 1980 or 1973, a recession always follows. And not only that, the recession that follows is usually pretty severe, pretty long. On average, the negative impacts of an inflation recession last 2 to 3 years. Now, to combat this inflation, the Federal Reserve is increasing interest rates at a historically high pace. They just announced another 75 basis point interest rate hike, which now brings the short-term federal funds rate to 2.3%. You can see that that is actually still a very historically low federal funds rate, especially in comparison to how high the inflation is right now. So when you see the yellow inflation line so much above the interest rate line, that's an indication that the Federal Reserve is going to need to hike rates more into the future. Just how much more is the Fed going to hike rates? Well, again, let's ask Jerome Powell.
Probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%.
He's projecting another 100 basis points of interest rate hikes throughout the rest of 2022, which means that over the next 3 FOMC meetings, it's likely we're going to have a 50 basis point hike and then 2 25 basis point hikes. And the reason these interest rate hikes are so problematic for the U.S. economy is because over the last 20 years, our economy has gotten very used to cheap debt, free money flowing through the economy. We've gotten used to the government government coming to bail us out every time the economy is taking a dip, which has created the largest debt bubble in America of all time. We can see right now there's over $63 trillion of cumulative debt in America between the government, U.S. households, and corporations. And today's debt to GDP rate of 261%, it's more than double the rate in the 1970s, the last time inflation was this high. And so when you combine a raging debt bubble with big interest rate hikes, that equation is going to equal lots and lots of defaults and bankruptcies. Because right now in America, we have lots of zombie companies, companies who lose money and whose existence was predicated on the fact that they could borrow cheap debt. Well, no longer is that debt cheap. Every time a corporation refinances their bonds, it's going to get more expensive. Meanwhile, any consumer who now has an active credit card balance, they're going to be paying more in credit card interest because of these interest rate hikes. And anyone who buys a house is now going to be paying more in mortgage interest. All this combines to mean that we have not yet seen any real economic pain. That economic pain is coming into the future over the next 6 to 12 months. And as that occurs, the layoffs are going to surge, bankruptcies are going to surge, and asset prices across the housing market and the stock market are going to collapse further. But what's very interesting is over the last month, the stock market is rallying right now. They're ignoring all this news. The NASDAQ is up 10%. The S&P 500 is up 8%. A lot of traders and speculators are acting as if the recession is already over, as if it's already come and gone. So what gives? Why is the stock market booming over the last month when we have bad economic news coming out? And the answer, of course, is that the stock market has turned into a casino game over the last 2 decades, where it's filled with speculators who don't actually buy companies based on their true underlying value. They buy companies in hopes of making a quick buck and then dumping the stock at its peak. And it's very important you all don't get sucked into this bear market rally, because this is a sucker's game, and there's going to be a lot of people who are buying into stocks right now who are going to get absolutely destroyed as this recession plays out and the stock market continues to collapse. Because if we look at previous recessions and economic downturns, we can see this is what tends to happen. In the 2001 dot-com bubble, we can see the S&P 500 peaked in August 2000. It then went down by about 17% through March 2001 before having a 8% rally over the next 2 months. Then it went down by another 15% over the next 6 months before having another rally at plus 10%. And interestingly, it was then the next downturn in the S&P 500 from March 02 to September 02, which was the biggest. So in aggregate, the S&P declined by nearly 50% from 2000 to 2002, but there was 3 bear market rallies along the way that sucked people in, tricked people into thinking that the downturn was over before absolutely crushing their investment. What this highlights for everyone, very important you all understand this, is that you need to pay attention not to the short-term movements in stock prices or housing prices or the short-term movements in sentiment. You need to pay attention to the fundamentals. What do the long-term data fundamentals say about the health of the economy, the health of the stock market, and the health of the housing market? For instance, on the housing market, we can see that according to the Case-Shiller Home Price Index, home prices are at their highest level of all time adjusted for inflation in 2022. Even with the beginning of the crash, prices are still way higher than they've ever been, even higher than they were in 2006. And so if you're someone who's thinking about whether you should buy a house right now, you should take a look at that graph and understand that if you do, you are buying at an all-time high price. You're paying more than anyone ever has for a home in inflation-adjusted terms. Do you want to do that heading into a recession where the chair of the Federal Reserve is predicting worse economic growth, is predicting layoffs going forward? How healthy do you think the underlying economy of America is? Do you think the record low unemployment rate and the high job gains in the last 6 months are supported by companies that are productive and make money? Or do you think there's a lot of fake jobs in America where due to pandemic stimulus and decades of low interest rates, there's been a lot of malinvestment and a lot of zombie companies hiring people and operating despite the fact that they don't make money? I sympathize more with the latter argument because when I look at data on the stock market, I see that in 2021, 40% of publicly traded companies had negative earnings, meaning they lost money in 2021. That is the highest level of all time. And the reason that that's the case is because the last 2 decades have built in this idea in America that profitability isn't important anymore. Everyone seems to want to invest in the next Amazon or Tesla, companies that lost money for a while before booming. So they think the entire economy can operate like that. But folks, I think we all know that's not true. At some point, companies need to turn a profit. And that's going to be even harder for companies to do going forward with inflation and rising interest rates. So my prediction is that this low unemployment rate, this is not going to last. This is a house of cards based off the massive debt bubble we have in America. And over the next 6 to 12 months, there's going to be a point in time where the unemployment rate just starts shooting up out of control. That's what tends to happen in a recession. At first, the unemployment rate kind of moves along slowly, it remains low, and then all of a sudden it goes up a bit, and then bam. You can see this is something that happened in 2007, 2008. We can look at the blue line unemployment rate here. It stayed around 4.5% to 5% for a long time. Even as the stock market was declining, the unemployment rate was low. But then between April 2008 and April 2009, the unemployment rate nearly doubled from 5 to 9%. Another great example of how fast the unemployment rate can shoot up and how layoffs can go out of control is the 1973 recession. This was a long inflationary recession. We can see that unemployment rates stayed relatively low, stayed around 5%. May 1974 was 5.1%, and then bam, over the next year, it nearly doubled to 9%. Finally, I'm going to leave you all with my prediction for when this recession is going to get very severe. When are the declines in the housing market and the stock market going to bottom out? When I look at the historical recession data, whether it be on consumer sentiment or declines in the S&P 500 or increases in unemployment rate or the yield curve inversion we're seeing in America right now, this data all points to us being at least 12 to 18 months away from the bottom. And it also points to the fact that in the interim, we are going to see periods of confusion where there's rallies, where people get more optimistic sentiment, and it's important for you all to understand that that's just part of the process. That's what happens during a recession. There's times that are confusing and people don't know what the future is, but if you keep your eye on the fundamental data, you're going to know when the time to strike is going to be.